Namaste. In the previous module, we discussed about the classification of financial markets into money market and capital market. Then we discussed about what do you mean by money market, what are the instruments traded in a money market. Now, we shall be now discussing about distinction between capital market and money market, then classification of capital market into primary market and secondary market. Basically, the difference between capital market and money market arise due to the following factors. Number one, participants. Participants in a money market are generally government, banks, Reserve Bank of India, financial institutions, mutual funds, etc. While the participants of capital market are general public, banks, insurance companies, etc. The instruments traded in a primary money market are in the form of call money, treasury bills, commercial paper, etc. While the instruments traded in a capital market are in the form of shares, debentures, bonds, etc. The investment outlay in a money market is not always huge. It's very voluminous and the face value is also very high, say from 25,000 onwards. On the other hand, the capital market instruments are normally small denominated instruments. Face value is normally ranging between say 10 and 100 and the investment outlay is comparatively smaller than money market instruments. The next one is the duration of money market instruments are not exceeding 365 days, while the duration of capital market instruments are always for longer period of time. The money market instruments are highly liquid in comparison with capital market instruments. Since the duration is very less and they are very highly liquid, they are very safe also. Investment in money market instruments are always safer than investment in capital market instruments. And the expected return on investment will obviously be more in case of capital market because longer duration, high risk ventures. Higher risk is always associated with higher profits. Therefore, return on investment in capital market is always higher than the return on investment on money market instruments. So, we discussed about the difference between capital market and money market on the basis of participants. Participants in money market instruments are government, banks, financial institutions, etc. Whereas participants in capital market are general public, mutual funds, insurance companies, etc. Instruments traded in money market are in the form of treasury bills, commercial papers, certificate of deposit, etc. While the instruments traded in a capital market are in the form of equity shares, preference shares, bonds, etc. Investment outlay in money market instrument is always very high in comparison with capital market instruments. The duration of money market instruments are less than 1 year, while the duration of capital market instruments are always very long. Money market instruments are always very liquid because they are for very short span of time. But investment in capital market investment instruments will be for a longer period of time. Obviously, when the investment is for a shorter period of time and it is highly liquid, safety of investment is very high in case of money market instruments in comparison with capital market instruments. Obviously, capital market instruments will give higher return on investment than money market instruments. Now, moving on to classification of capital market into two, primary market and secondary market. Primary market is otherwise called as new issues market. This is a market for first time sale of securities. Please remember, in a primary market, only sale of securities take place. There are no buying and selling of securities. It is only sale of securities. Companies approach the investors directly. So, it is only through primary market direct capital formation takes place. And the participants of primary market are banks, financial institutions, general public, etc. The instruments traded are shares, that is equity and preference shares, then bonds, etc. And funds are raised normally for expansion of the business or setting up of a new business or infrastructure projects, etc. Now, what are the ways in which funds can be raised in a primary market? Methods of flotation in a primary market. The most common one is called as issue through prospectus. It's a very common one. It has a mass reach. So the companies which want to access to large number of population will go for issue through prospectus. This is called as going public. So private companies want to become public limited companies, or partnership business want to go for public limited company will go for raising money in the market only by issue through prospectus. Prospectus is any written document inviting the public at large to subscribe for the shares and debentures of a body corporate. So prospectus must be very carefully drafted, duly signed by the signatories. Any misstatement in the prospectus will lead to criminal liability on the part of the signatories. Prospectus is a document which contains complete information about the company. So, an investor will read the prospectus thoroughly before investing money in the particular company. Therefore, prospectus must be as clear as possible. The next method is offer for sale. Now, issue through prospectus has its own advantage that it has a mass appeal. It is able to reach large number of population. Easy way to contact large number of population, no doubt at all. But the prospectus has to be very carefully drafted. It has to be as rosy as possible because it has to attract the investors to invest money. So those companies which are financially strong would prefer to raise money by the issue of prospectus. But the companies which do not want to spend more, or the companies which do not have such financial ability, will prefer to go for alternative methods of raising money. The one method is offer for sale. Now, instead of issuing prospectus to the public at large, issuing shares to the public at large, the company will sell the shares to certain financial intermediaries, who in turn will sell it to the public at large. Therefore, the company's responsibility of raising money from the public at large is considerably reduced. Still more cost-effective method is private placement, where the company is very prudent in raising money. The company cannot access to stock market very easily. The company would prefer to raise money by private placement. Now, private placement is supposed to be most cost effective because the company will sell the shares to the intermediaries, who in turn will sell these shares to certain financial institutions like mutual funds, insurance companies, etc. Therefore, fund mobilization becomes very easy. The next method of raising money is rights issue. When the company goes for second time issue of shares, instead of offering it to the public at large, the company will raise money by offering it to the existing shareholders, what we call as preemptive right of the equity shareholders. Preemptive right of equity shareholder means when the company goes for second time issue of shares, instead of offering it to the public at large, before that the company should offer it to the existing shareholders. What is not subscribed by the existing shareholders alone will be given for public subscription. To draw the attention of the existing shareholders, the company normally reduces the price to the existing equity shareholders, what is called as the value of right. So the next method of raising money in primary market is rights issue. Rights issue is the right given to the existing equity shareholders, what is called as preemptive right. When an existing company goes for second time issue of shares, before offering it to the public at large, the company will offer it to the existing equity shareholders. What is not subscribed by the existing shareholders alone will be given to the public at large. Now, to motivate the existing shareholders to subscribe for additional number of shares, the company will issue the shares at a price much below the price at which it is issued to the public at large. The difference between the price at which it is issued to the public at large and the price paid by the existing equity shareholders is called as the value of right. That is a gain to the equity shareholders by subscribing for the shares of the company. The benefit to the company is the control is not diluted. The control is vesting continuously with the existing shareholders. And from the shareholders' point of view, they get more return on investment from the same company. So that is the advantage of rights issue. The last one is the latest one, EIPOs. So, online trading of stocks and securities is called as EIPOs, Electronic Initial Public Offer. Initial public offer. The company which prefers to go for EIPOs will have to get in touch with the stock exchange. The stock exchange will appoint his nominee to monitor the transactions which are taking place in the online trading of shares and securities. There will be a coordinator who will liaison between the company and the stock exchange. So, this is what is called as EIPO or Electronic Initial Public Offer. So, these are the various methods of flotation in primary stock market. So, issue through prospectus is the mass method of appealing to the public at large. It is done through issue of prospectus, which is a written circular or a notice inviting the public to subscribe for shares and debentures of the body corporate. The prospectus should be very carefully drafted, should not contain any misstatement. Issue through prospectus is a costly affair, so the companies which want to economize their operations would prefer to go for offer for sale, wherein the company will issue shares to certain selected intermediaries who will take the responsibility of mobilizing funds from the public at large. Still cost-effective method is by way of private placement, wherein the company will sell shares to the intermediaries who in turn will sell it to financial institutions, insurance companies and mutual funds. The other method of raising money is through rights issue, where the company is going to raise money by offering shares to the existing equity shareholders. These shareholders are issued additional number of shares for a price much lesser than the price at which it is issued to the public at large. What we call as the value of right. The gain that they get is called as the value of right. The companies which want to raise money through online transactions will go for EIPOs. The company which wants to raise money through EIPO will have to register with the stock exchange, which is not the stock exchange in which their funds are already floated. Now, the stock exchange will appoint their nominee who will monitor the proceedings that are taking place. There will be a coordinator who will coordinate the activities of the company with the nominee of the stock exchange. All the transactions will be recorded and monitored by the stock exchange. These are the various methods. So now, in the secondary market, now we shall be discussing about stock exchange. Secondary market is a market for purchase and sale of existing securities. So, there is a capital transformation indirectly taking place. So, the shares and securities which are already bought in the primary sector, primary market, is being sold in the secondary market. So, because of this, what happens? Investment, reinvestment takes place in a secondary market. So, secondary market deals with existing securities, sale and purchase of existing securities. Now, what are the functions performed by a stock exchange? Now, stock exchange is considered to be the watchdog of securities market. So, stock exchange guarantees the securities traded in the stock exchange. Therefore, entering into stock exchange register is not a very easy job. What is called as listing in stock exchange. Listing is a process of including the name of the company in the official index of companies maintained by a stock exchange. Only listed companies can be traded in stock exchange. So, stock exchange acts as a guarantor for the securities traded in a stock exchange. Now, what are the functions performed by stock exchange? Number one, providing liquidity and marketability for the existing securities. So, the investors purchase and sale of securities, purchase and sell securities, by which investment and reinvestment takes place. By which what happens is, the liquidity is there and greater marketability for the existing securities take place. Now, when investment in reinvestment take place, the value for securities increases. So the investor gets best price for the security. So ideal pricing for securities take place. Then stock exchange watches the movement of securities. Stock exchange acts as a guarantor for investment in these securities. Therefore, there is safety of transaction. So investors can be rest assured that their money will be safe. The next is, since the stock exchange contributes for purchase and sale of existing securities, more and more securities purchase and sale takes place, which contributes to economic growth. So, more shares are dealt in stock market, more new companies come up, their shares are being bought and sold in the stock market, by which economic growth of the country increases, improves. The next is spreading of equity cult. In general, people have certain fear for investment in equity shares because they are very highly risky. Because of that, people would prefer to go for safe investments. If everybody think of investing money only in safe avenues, then how will country improve? Where is the scope for capital growth? Where is the scope for capital formation? Only by equity shares, company is able to raise large money for their business operations. So, stock market acts as a guarantor for securities market, by which investors gain confidence in investing money in equity shares. So, people think investing in equity shares is not very dangerous. It is safe also, by which more people buy and sell equity shares. Because of that, more and more industries come up in the country. And stock market provides a scope for speculation also. Please remember, there is a possibility of a gain only when there is an increase in the price. Otherwise, the same price is going to be transferred from one person to another person. Nobody is gaining. Only by market forces. When demand for a particular company's shares increase, price of the companies increase. So, there is a possibility of speculation in the stock market, a healthy speculation, a reasonable speculation is provided in the stock market, by which profit earning is also possible by investing in securities market. So, these are the functions performed by stock exchange or securities market. So, I revise the functions of stock market. Stock market acts as a security watchdog for the securities traded in a stock market. Now, the functions performed by stock exchange are providing liquidity and marketability to existing securities. The existing investors, when they buy and sell securities from one company to another company, they invest and reinvest, by which more liquidity is enhanced to the investments and better marketability for the securities also take place. And when securities are bought and sold, they get a better price. So, pricing of securities take place in a stock market. Since the stock market acts as a guarantor for securities traded in the stock market, there is safety of transaction. So, investors can be rest assured about their investment. Then, by investing money in equity shares, more economic growth is assured. So that more companies will come up, more capital formation will take place. When stock market acts as a guarantor for the securities traded, the investors will think of investing more money in equity shares. When more money is invested in equity shares, more funds are generated, more capital formation will take place. So, spreading of equity cult. Stock market provides for considerable scope for speculation. When securities are purchased and sold, there is a possibility of increase and decrease. Because of that, the demand and supply for the securities will change. The forces of market for the securities will determine the increase or decrease in the price of securities. Accordingly, the speculation will be there. Only when there is speculation, there will be change and there will be profit to be made by the investors. So, securities market provides way for speculation also. These are the functions of stock market. In the next session, we shall be discussing about Securities Exchange Board of India, SEBI, their objectives, their functions in development functions, regulatory functions and protective functions. Namaste.